1. What is the price of a bond with a face value of 1,000 rupees, a coupon rate of 8%, payable annually, and a YTM of 10%? A. 950 rupees. B. 1,000 rupees. C. 920 rupees. D. 970 rupees. To find the price of the bond, we use the present value, PV, formula for bond pricing, P equals sigma C, divided by 1 plus R, to the power of T, plus F divided by 1 plus R, to the power of N. Where P equals price of the bond, C equals coupon payment, 8% of 1,000 rupees equals 80 rupees. R equals yield to maturity, YTM, per period, 10% or 0.10. F equals face value, 1,000 rupees. N equals number of years to maturity, assuming it's a perpetual bond unless otherwise stated. If it's a simple 5-year bond, common assumption, we discount each cash flow. P is equal to, the summation from, T equals 1 to 5, of 80 divided by 1.10 raised to the power of T, plus 1,000, divided by 1.10, raised to the power of 5. Let's calculate. 1. Present value of coupon payments. 80 into 1 minus 1.10 to the power of minus 5, divided by 0.10 equals 80 into 3.7908 equals 303.26. Present value of face value. 1,000 divided by 1.10, power of 5 equals 1,000 divided by 1.6105 equals 620.92. Total price. 303.26 plus 620.92 equals 924.18. The closest answer is C. 920 rupees.
2. Which of the following types of funds typically have the least price risk? A. Long-term debt funds. B. Gilt funds. C. Money market funds. D. Equity funds. Answer. The type of fund that typically has the least price risk is C. Money market funds. Explanation. Money market funds. These funds invest in short-term, low-risk securities such as treasury bills, commercial paper, and certificates of deposit. Due to their focus on highly liquid and stable investments, money market funds are designed to preserve capital and provide liquidity, resulting in minimal price risk compared to other types of funds. Other options. A. Long-term debt funds. These can have significant price risk due to interest rate fluctuations over longer maturities. B. Gilt funds. While they invest in government securities, they still carry interest rate risk that can affect their prices. D. Equity funds. These are subject to higher volatility and market risk, making them much riskier than money market funds. Therefore, the correct answer is C. Money market funds. 3. Yield to maturity, YTM, of a bond measures. A. Annual coupon payments as a percentage of face value. B. Total returns earned if the bond is held till maturity. C. The change in bond price due to interest rate movements. D. The average annual return on equity. Answer. Yield to maturity, YTM, of a bond measures. B. Total returns earned if the bond is held till maturity. Explanation. Yield to maturity, YTM, is the total return anticipated on a bond if it is held until it matures. It accounts for all future coupon payments and any capital gains or losses that may occur if the bond was purchased at a price different from its face value. YTM is expressed as an annual rate and assumes that all coupon payments are reinvested at the same rate as the YTM itself. Therefore, the correct answer is B. Total returns earned if the bond is held till maturity. 4. Which of the following benchmarks is most appropriate for debt mutual funds in India? A. BSE Sensex. B. NSE Nifty. C. CRISIL Bond Fund Index. D. MIBOR. Answer. The most appropriate benchmark for debt mutual funds in India is C. CRISIL Bond Fund Index. Explanation. CRISIL Bond Fund Index. This index is specifically designed to track the performance of various debt mutual funds in India. It provides a relevant benchmark against which the performance of debt funds can be measured, reflecting the returns of fixed income securities such as government and corporate bonds. Other options. A. BSE Sensex and B. NSE Nifty. These are equity indices and are not suitable benchmarks for debt mutual funds. D. MIBOR. The Mumbai Interbank Offered Rate is a benchmark interest rate for lending between banks, not a direct benchmark for mutual fund performance. Therefore, the correct answer is C. CRISIL Bond Fund Index. 5. The total return of a mutual fund includes A. Dividends paid to unit holders. B. Capital appreciation or depreciation. C. Both A and B. D. None of the above. Answer. The total return of a mutual fund includes C. Both A and B. Explanation. Total return. The total return of a mutual fund encompasses all sources of income generated by the investment. This includes A. Dividends paid to unit holders. These are distributions made from the fund's earnings to its investors. B. Capital appreciation or depreciation. This refers to the increase, or decrease, in the value of the fund's investments over time. Thus, the total return is a comprehensive measure that accounts for both income received from dividends and any changes in the value of the investment. Therefore, the correct answer is C, both A and B. 6. A bond has a duration of 5 years. If interest rates rise by 1%, its price will approximately A. Increase by 5%, B. Decrease by 5%, C. Remain constant. D. Cannot be determined. Answer. If a bond has a duration of 5 years and interest rates rise by 1%, its price will approximately B. Decrease by 5%. Explanation. Duration is a measure of a bond's sensitivity to changes in interest rates. Specifically, it indicates how much the price of the bond is expected to change for a 1% change in interest rates. The general rule of thumb is that for each 1% increase in interest rates, the price of the bond will decrease approximately by an amount equal to its duration in percentage terms. In this case, since the duration is 5 years, a 1% increase in interest rates would lead to an approximate decrease in the bond's price by about 5%. Therefore, the correct answer is B, decrease by 5%. 7. As per SEBI regulations, a mutual fund scheme can invest up to how much of its net assets in the equity of a single company? A. 10%. B. 20%. C. 25%. D. 15%. Answer. As per SEBI regulations, a mutual fund scheme can invest up to C. 10% of its net assets in the equity of a single company. Explanation. According to the SEBI mutual funds regulations, mutual funds are restricted from investing more than 10% of their net assets in the equity shares or equity-related investments of any single issuer. This limit helps to ensure diversification and manage risk within the fund's portfolio. Therefore, the correct answer is C, 10%. 8. A mutual fund is allowed to A. Invest in financial derivatives. B. Lend securities under SEBI stock lending scheme. C. Trade in options and futures. D. All of the above. Answer. A mutual fund is allowed to D. All of the above. Explanation. Invest in financial derivatives. Mutual funds can invest in financial derivatives as part of their investment strategy, which allows them to hedge risks or enhance returns. Lend securities under SEBI stock lending scheme. Mutual funds are permitted to lend securities to earn additional income through the stock lending mechanism established by SEBI. Trade in options and futures. Mutual funds can also trade in options and futures, which are types of financial derivatives, to manage risk or enhance returns. Given that all the options listed are permissible under SEBI regulations for mutual funds, the correct answer is D, all of the above. 9. A mutual fund scheme is prohibited from A. Borrowing money for investment purposes. B. Underwriting securities. C. Lending to corporates. D. All of the above. Answer. A mutual fund scheme is prohibited from D. All of the above. Explanation. Borrowing money for investment purposes. Mutual funds are generally not allowed to borrow money to invest, as this could increase risk and complicate their investment strategies. Underwriting securities. Mutual funds cannot underwrite securities, which involves guaranteeing the sale of a new issue of securities, as this could lead to conflicts of interest and increased risk exposure. Lending to corporates. Mutual funds are also prohibited from lending directly to corporates, as this could expose them to credit risk. Given these restrictions, the correct answer is D, all of the above. 10. What is the maximum permissible investment by a mutual fund in money market securities during the first 6 months from its IPO? A. 100%. B. 75%. C. 50%. D. It depends on the scheme. Answer. The maximum permissible investment by a mutual fund in money market securities during the first 6 months from its IPO is A. 100%. Explanation. According to SEBI regulations, Mutual funds are allowed to invest up to 100% of their net assets in money market instruments during the initial period following their IPO. This flexibility enables them to manage liquidity effectively while also taking advantage of short-term investment opportunities. Therefore, the correct answer is A, 100%. 11. If a mutual fund's NAV rises from 10 rupees to 12 rupees in 18 months, the CAGR is A, 12.5%, B, 13.4%, C, 10.5%, D, 15.2%. To calculate the compounded annual growth rate, CAGR, we use the formula CAGR equals PV divided by FV, to the power of 1 divided by T, minus 1. Where FV equals final value, 12 rupees. PV equals initial value, 10 rupees. T equals time in years, 18 months equals 1.5 years. Substituting the values, CAGR equals 12 divided by 10, to the power of 1 divided by 1.5, minus 1. CAGR equals 1.2, to the power of 1 divided by 1.5, minus 1. CAGR equals 1.1255 minus 1 equals 0.1255 or 12.55%. The closest answer is A. 12.5%. 12. What does fundamental analysis include? A. Analysis of the company's financial statements. B. Review of stock market performance. C. Industry-level economic analysis. D. All of the above. Answer. Fundamental analysis includes D. All of the above. Explanation. Fundamental analysis is a comprehensive approach used to evaluate the intrinsic value of a security by examining various factors, including A. Analysis of the company's financial statements. This involves reviewing key financial documents such as the balance sheet, income statement, and cash flow statement to assess the company's profitability, revenue growth, expenses, and overall financial health. B. Review of stock market performance. While fundamental analysis primarily focuses on the company's fundamentals, it also considers how the stock has performed in the market relative to its peers and historical performance. C. Industry-level economic analysis. This includes analyzing broader economic indicators and industry trends that could impact the company's performance, such as market demand, competition, regulatory environment, and economic conditions. Given that all these components are integral to a thorough fundamental analysis, the correct answer is D. All of the above. 13. Mutual funds in India can invest in A. Real estate investment trusts, REITs. B. Derivatives for hedging. C. Government securities. D. All of the above. Answer. Mutual funds in India can invest in D. All of the above. Explanation. A. Real estate investment trusts, REITs. Mutual funds are allowed to invest in REITs, which provide exposure to real estate assets. B. Derivatives for hedging. Mutual funds can use derivatives to hedge their investments, managing risk associated with market fluctuations. C. Government securities. Mutual funds can invest in government securities, which are considered low-risk fixed-income instruments. Since all these investment types are permissible under SEBI regulations for mutual funds, the correct answer is D. All of the above. 14. What affects the volatility of a mutual fund? A. Number of securities in the portfolio. B. Market conditions. C. Type of assets in the portfolio. D. All of the above. Answer. The factors that affect the volatility of a mutual fund include D. All of the above. Explanation. A. Number of securities in the portfolio. The diversification of a mutual fund's portfolio can influence its volatility. A fund with a larger number of securities may experience less volatility than one concentrated in a few holdings, as the risks are spread out. B. Market conditions. Broader market conditions, including economic indicators, geopolitical events, and investor sentiment, significantly impact volatility. Changes in these conditions can lead to fluctuations in the value of the fund's assets. C. Type of assets in the portfolio. Different asset classes, for example, equities, bonds, derivatives, have varying levels of inherent volatility. For instance, equity funds tend to be more volatile compared to debt funds due to the nature of stock price movements. Given that all these factors contribute to the overall volatility of a mutual fund, the correct answer is D. All of the above. 15. What is the Sharpe ratio? A. A measure of risk-adjusted returns. B. A measure of standard deviation of returns. C. A measure of the fund's correlation with the market. D. None of the above. Answer. The Sharpe ratio is A. A measure of risk-adjusted returns. Explanation. Sharpe ratio defined. The Sharpe ratio is a financial metric that measures the performance of an investment, such as a mutual fund, compared to a risk-free asset, after adjusting for its risk. It is calculated by subtracting the risk-free rate of return from the expected return of the investment and then dividing this result by the standard deviation of the investment's returns. The formula is Sharpe ratio equals Rp minus Rf, divided by sigma p, where Rp equals expected return of the portfolio, Rf equals risk-free rate, sigma p equals standard deviation of the portfolio's excess return. A higher Sharpe ratio indicates better risk-adjusted performance, meaning the investment has provided higher returns per unit of risk taken. Therefore, the correct answer is A, a measure of risk-adjusted returns. 16. Index funds aim to achieve A. Higher than market returns. B. Returns in line with the market index. C. Lower volatility than market indices. D. Guaranteed returns. Answer. Index funds aim to achieve B. Returns in line with the market index. Explanation. Index funds defined. Index funds are mutual funds or exchange-traded funds, ETFs, designed to replicate the performance of a specific market index, such as the Nifty 50 or the S&P 500. The primary objective of these funds is to match the returns of the index they track, rather than to outperform it. Other options. A. Higher than market returns. This is not the goal of index funds, as they do not actively manage investments to seek out performance. C. Lower volatility than market indices. Index funds typically have similar volatility to the index they track since they invest in the same securities. D. Guaranteed returns. There are no guarantees in investing. Index funds are subject to market risks and can experience fluctuations in value. Therefore, the correct answer is B. Returns in line with the market index. 17. What is a gilt fund? A. A fund that invests only in gold-backed securities. B. A fund that invests in government securities. C. A fund that guarantees returns. D. None of the above. Answer. A gilt fund is B. A fund that invests in government securities. Explanation. Gilt funds defined. Gilt funds are a type of debt mutual fund that primarily invests in government securities, G-Seconds, issued by the central and state governments. These funds are designed for conservative investors seeking low-risk investment options, as government securities are considered to have minimal credit risk. Characteristics: gilt funds typically invest at least 80% of their assets in government bonds, which can vary in maturity. They aim to provide stability and reasonable returns while being subject to interest rate fluctuations. Therefore, the correct answer is B, a fund that invests in government securities. 18. The X mark of an index fund measures A. The tracking error. B. The percentage of funds not invested in the index. C. The correlation between the fund and the index. D. The expense ratio. Answer. The X mark of an index fund measures A. The tracking error. Explanation. X mark refers to a measure that indicates how closely a fund's returns correspond to the returns of the market index it is designed to track. It essentially reflects the tracking error, which is the difference between the performance of the fund and the performance of the benchmark index. A lower X mark indicates that the fund closely follows the index, while a higher X mark suggests greater divergence from the index's performance. Therefore, the correct answer is A, the tracking error. 19. A money market fund is primarily designed for A. Long-term growth. B. Parking short-term surplus funds. C. Investing in equity markets. D. Hedging risks in portfolios. Answer. A money market fund is primarily designed for B. Parking short-term surplus funds. Explanation. Money market funds defined. Money market funds are a type of mutual fund that invests in short-term, high-quality debt instruments, such as treasury bills, commercial paper, and certificates of deposit. They are designed to provide investors with a safe place to park their short-term surplus funds while earning a modest return. Characteristics: these funds typically offer high liquidity and low risk, making them suitable for investors looking to preserve capital and maintain easy access to their funds without the volatility associated with equity markets or long-term investments. Therefore, the correct answer is B, parking short-term surplus funds. 20. Which type of fund invests in equity and debt instruments in a fixed proportion? A. Balanced funds. B. Debt funds. C. Equity funds. D. Arbitrage funds. Answer. The type of fund that invests in equity and debt instruments in a fixed proportion is A. Balanced funds. Explanation. Balanced funds defined. Balanced funds, also known as hybrid funds, are designed to maintain a specific allocation between equity, stocks, and debt, bonds, instruments. They aim to provide a mix of growth and income by investing in both asset classes, typically maintaining a predetermined ratio, for example, 60% equities and 40% debt, to achieve a balance between risk and return. Investment strategy. These funds are suitable for investors seeking moderate risk with potential capital appreciation and income generation, making them an attractive option for those looking to diversify their portfolios. Therefore, the correct answer is A. Balanced funds. 21. NAV is the A. Price per unit of a mutual fund. B. Total value of assets of a scheme. C. Total liabilities of a scheme. D. None of the above. Answer. NAV is the A. Price per unit of a mutual fund. Explanation. NAV, net asset value. NAV represents the price per unit of a mutual fund scheme. It is calculated by dividing the total value of the fund's assets minus its liabilities by the number of outstanding units. The formula is NAV equals total assets minus total liabilities divided by number of outstanding units. Importance. NAV is crucial for investors as it determines the price at which they can buy or sell units in the mutual fund. It reflects the fund's performance and is updated regularly, usually daily. Therefore, the correct answer is A. Price per unit of a mutual fund. 22. Which of these cannot be a benchmark for a mutual fund scheme? A. Nifty 50. B. S&P 500. C. GDP growth rate. D. Crystal Liquid Fund Index. Answer. The option that cannot be a benchmark for a mutual fund scheme is C. GDP growth rate. Explanation. A. Nifty 50 and B. S&P 500 are both well-established stock market indices that serve as benchmarks for equity mutual funds, allowing investors to compare fund performance against these indices. D. Crystal Liquid Fund Index is specifically designed for liquid funds and serves as a benchmark for those types of mutual funds. In contrast, the GDP growth rate measures the economic performance of a country and does not represent a specific investment portfolio or market index, making it unsuitable as a benchmark for mutual funds. Therefore, the correct answer is C. GDP growth rate. 23. Alpha of a mutual fund indicates A. The excess returns earned over the benchmark. B. The risk-adjusted return. C. The total return over a year. D. The portfolio's correlation with the market. Answer. Alpha of a mutual fund indicates A. The excess returns earned over the benchmark. Explanation. Alpha defined. Alpha measures the performance of a mutual fund relative to a benchmark index, indicating how much more, or less, the fund has returned compared to what would be expected based on its risk profile. A positive alpha signifies that the fund has outperformed its benchmark, while a negative alpha indicates underperformance. Calculation. Alpha is calculated by subtracting the expected return, based on the benchmark and the fund's risk, measured by beta, from the actual return of the fund. This makes it a crucial metric for evaluating a fund manager's ability to generate excess returns through active management. Therefore, the correct answer is A. The excess returns earned over the benchmark. 24. Arbitrage funds take advantage of A. Differences in prices of securities in two or more markets. B. Long-term growth opportunities. C. Fixed returns on securities. D. Changes in interest rates. Answer. Arbitrage funds take advantage of A. Differences in prices of securities in two or more markets. Explanation. Arbitrage funds defined. These funds operate by exploiting price discrepancies between different markets, typically between the cash, spot, market and the futures market. For example, an arbitrage fund may buy a security at a lower price in the cash market and simultaneously sell it at a higher price in the futures market, thereby locking in a profit from the price difference. Investment strategy. The strategy relies on identifying and capitalizing on temporary price differences, allowing arbitrage funds to generate returns with relatively low risk compared to traditional equity investments. Therefore, the correct answer is A. Differences in prices of securities in two or more markets. 25. A zero-coupon bond. A. Pays regular interest. B. Does not pay interest during its term but is sold at a discount. C. Pays higher interest than regular bonds. D. Is traded only in money markets. Answer. A zero-coupon bond. B. does not pay interest during its term but is sold at a discount. Explanation. Zero coupon bond defined. A zero coupon bond is a type of bond that does not make periodic interest payments, coupons. Instead, it is issued at a discount to its face value and pays the full face value at maturity. The difference between the purchase price and the face value represents the investor's return. Characteristics. Since it does not pay interest during its term, investors benefit from the appreciation in value as the bond approaches maturity. Zero-coupon bonds are often used for long-term investment goals, such as saving for education or retirement, as they can provide a lump sum at maturity. Therefore, the correct answer is B, does not pay interest during its term but is sold at a discount. 26. Maximum management fees allowed for equity mutual funds in India are A. 1.5%, B. 2.25%, C. 2.50%, D. 3.0%. Answer. The maximum management fees allowed for equity mutual funds in India are B. 2.25%. Explanation. According to SEBI regulations, the maximum total expense ratio, DER, for equity mutual funds is structured based on the assets under management, AUM. For the first 500 crore of AUM, the maximum TER is set at 2.25%. This limit is designed to protect investors by ensuring that mutual funds do not charge excessively high fees relative to the services provided. 27. In mutual funds, expense ratio includes A. Fund management fees, B. Distribution costs, C. Custodian charges, D. All of the above. Answer. In mutual funds, the expense ratio includes D. All of the above. Explanation. The expense ratio of a mutual fund encompasses various costs associated with managing the fund, which typically include A. Fund management fees. This is the fee paid to the fund managers for their expertise in managing the investments and making decisions on behalf of the investors. B. Distribution costs. These are expenses related to marketing, selling, and distributing the mutual fund, which may include commissions paid to financial advisors and brokers. C. Custodian charges. These are fees paid to custodians who hold and safeguard the fund's assets, ensuring proper management and compliance with regulations. All these components contribute to the total expense ratio, which is expressed as a percentage of the fund's average assets under management, AUM. Therefore, the correct answer is D, all of the above. 28. SIP, Systematic Investment Plan, offers A. Regular investment in mutual funds, B. Lump sum investment option, C. Guaranteed returns, D. Tax-free withdrawals. Answer. SIP, Systematic Investment Plan, offers A. Regular investment in mutual funds. Explanation. SIP defined, a systematic investment plan, SIP, allows investors to invest a fixed amount of money at regular intervals, such as monthly or quarterly, in a mutual fund. This approach helps in averaging the cost of investment over time and encourages disciplined saving. Benefits of SIP. Regular investment. Investors can build their investment portfolio gradually without needing to make a large lump sum investment. Repeat cost averaging. By investing regularly, investors can benefit from market fluctuations, buying more units when prices are low and fewer when prices are high. Other options. B. Lump sum investment option. This refers to a different method of investing in mutual funds, not specifically related to SIP. C. Guaranteed returns. SIPs do not guarantee returns, as mutual fund investments are subject to market risks. D. Tax-free withdrawals. Withdrawals from mutual funds may be subject to capital gains tax depending on the holding period and type of fund. Therefore, the correct answer is A. Regular investment in mutual funds. 29. The beta of a fund measures A. Risk-free returns, B. Sensitivity of the fund to market movements, C. The fund's historical volatility, D. Average returns. Answer. The beta of a fund measures B. Sensitivity of the fund to market movements. Explanation. Beta defined. Beta is a measure used in finance to determine the volatility or risk of a fund in relation to the overall market. It quantifies how much the fund's returns are expected to change in response to changes in the market index, usually represented by a benchmark like the Nifty 50 or S&P 500. Interpretation of beta values. A beta of 1 indicates that the fund's price moves with the market. A beta greater than 1 suggests that the fund is more volatile than the market, meaning it may experience larger price swings. A beta less than 1 indicates that the fund is less volatile than the market. Thus, beta provides investors with insights into how sensitive a mutual fund is to market movements, making B, sensitivity of the fund to market movements, the correct answer. 30. What is the maximum lock-in period for an ELSS fund? A. 1 year. B. 3 years. C. 5 years. D. 10 years. Answer. The maximum lock-in period for an ELSS, equity-linked savings scheme, fund is B. 3 years. Explanation. ELSS funds have a mandatory lock-in period of 3 years, which means that investors cannot withdraw or redeem their investments during this time. This lock-in period is designed to encourage long-term investment and is the shortest among various tax-saving instruments under Section 80C of the Income Tax Act, 1961. After the completion of the 3 years, investors have the flexibility to redeem their investments or continue holding them based on their financial goals. 1. The main purpose of asset allocation is A. Maximizing returns. B. Reducing risks through diversification. C. Timing the market. D. Identifying the best performing assets. Answer. The main purpose of asset allocation is B. Reducing risks through diversification. Explanation. Asset allocation defined. Asset allocation is the process of distributing investments across various asset classes, such as equities, bonds, real estate, and cash, to optimize the balance between risk and return according to an investor's goals, risk tolerance, and investment horizon. Risk reduction. By diversifying investments across different asset classes, investors can reduce the overall risk of their portfolio. Different asset classes often react differently to market conditions. When one asset class performs poorly, another may perform well, helping to stabilize returns. While maximizing returns, A, is a goal of investing, the primary focus of asset allocation is on managing risk through diversification. Therefore, the correct answer is B, reducing risks through diversification. 32. Which of the following ratios is used to compare a fund's performance with its benchmark? A. Expense ratio. B. Sharpe ratio. C. Alpha. D. Beta. Answer. The ratio used to compare a fund's performance with its benchmark is C. Alpha. Explanation. Alpha measures the excess return of a mutual fund compared to its benchmark after adjusting for risk. A positive alpha indicates that the fund has outperformed its benchmark, while a negative alpha suggests underperformance. This makes alpha a critical metric for assessing how well a fund manager is generating returns relative to the market. While the Sharpe ratio, B, assesses risk-adjusted returns, it does not directly compare performance against a benchmark. Beta, D, measures volatility relative to the market but does not indicate performance against a benchmark. The expense ratio, A, relates to the costs associated with managing the fund rather than performance comparison. Therefore, the correct answer is C, alpha. 33. A financial planner should recommend SIP to A. Investors with low risk tolerance. B. Investors looking for long-term wealth creation. C. Investors who want guaranteed returns. D. Investors preferring one-time investments. Answer. A financial planner should recommend SIP, Systematic Investment Plan, to B. Investors looking for long-term wealth creation. Explanation. Long-term wealth creation, SIPs are designed for investors who want to build wealth over time through regular, disciplined investments in mutual funds. They benefit from the power of compounding and repeat cost averaging, making them an effective strategy for accumulating wealth in the long run. Other options. A. Investors with low risk tolerance. While SIPs can be suitable for conservative investors, they are primarily focused on long-term growth rather than specifically catering to low-risk profiles. C. Investors who want guaranteed returns. SIPs do not guarantee returns, as mutual fund investments are subject to market risks. D. Investors preferring one-time investments. SIPs involve regular investments, which is contrary to a one-time investment strategy. Thus, the most appropriate recommendation is for B. Investors looking for long-term wealth creation. 34. A ULIP is A. A type of mutual fund. B. An insurance product that combines investment and insurance. C. A fixed income security. D. None of the above. Answer. A ULIP, unit-linked insurance plan, is B. An insurance product that combines investment and insurance. Explanation. Definition. A ULIP is a financial product that provides both life insurance coverage and investment opportunities. When you invest in a ULIP, Your premium payments are divided into two parts. One portion goes towards providing life insurance coverage, while the other is invested in various funds, such as equity or debt, based on the policyholder's preferences and risk appetite. Benefits: this dual nature allows policyholders to benefit from potential market-linked returns while also ensuring financial protection for their beneficiaries in case of an unfortunate event. ULIPs are designed to help achieve long-term financial goals while providing life cover. Thus, the correct answer is B, an insurance product that combines investment and insurance. 35. Which of the following best describes sector funds? A. They invest across various industries for diversification. B. They invest in specific sectors of the economy, like technology or healthcare. C. They invest only in government securities. D. They avoid high-risk sectors. Answer: sector funds are best described as B. They invest in specific sectors of the economy, like technology or healthcare. Explanation. Definition: sector funds are mutual funds or exchange-traded funds, ETFs, that focus their investments exclusively on companies operating within a particular industry or sector of the economy. Common examples include funds that invest in technology, healthcare, financial services, and energy sectors. Characteristics: these funds provide concentrated exposure to a specific sector, which can potentially lead to higher returns when that sector performs well. However, this concentration also increases volatility and risk since the fund's performance is closely tied to the fortunes of that particular sector. Comparison with other options. A. They invest across various industries for diversification. This is incorrect as sector funds do not diversify across industries, they focus on one specific sector. C. They invest only in government securities. This is not accurate, as sector funds primarily invest in equities of companies within a chosen sector. D. They avoid high-risk sectors. Sector funds can actually include high-risk sectors, depending on market conditions and investor preferences. Thus, the correct answer is B. They invest in specific sectors of the economy, like technology or healthcare. 36. Which risk does not apply to a debt mutual fund? A. Credit risk. B. Interest rate risk. C. Equity market risk. D. Liquidity risk. Answer: the risk that does not apply to a debt mutual fund is C. Equity market risk. Explanation. Credit risk. A. This applies to debt mutual funds as it involves the risk of the issuer defaulting on interest or principal payments. Interest rate risk. B. This is also relevant for debt mutual funds, as changes in interest rates can affect the value of the bonds held within the fund. Liquidity risk. D. This risk pertains to the ability to buy or sell securities without significantly affecting their price, and it applies to debt mutual funds as well. In contrast, equity market risk refers to the volatility and risks associated with investments in equity markets, which do not pertain to debt mutual funds that primarily invest in fixed income securities. Therefore, the correct answer is C. Equity market risk. 37. What is the minimum tenure for a public provident fund (PPF) account? A. 5 years. B. 10 years. C. 15 years. D. 20 years. Answer: the minimum tenure for a public provident fund (PPF) account is C. 15 years. Explanation. The PPF account has a mandatory lock-in period of 15 years, during which funds cannot be withdrawn completely. After this period, the account can be extended in blocks of 5 years if desired, but the initial tenure is set at 15 years. 38. ETFs differ from index funds primarily because A. ETFs trade on stock exchanges, while index funds do not. B. ETFs have a higher expense ratio than index funds. C. ETFs are actively managed, while index funds are passive. D. ETFs do not follow any index. Answer: ETFs differ from index funds primarily because A. ETFs trade on stock exchanges, while index funds do not. Explanation. Trading mechanism. ETFs, exchange-traded funds, are traded on stock exchanges like individual stocks, allowing investors to buy and sell them throughout the trading day at market prices. In contrast, index funds can only be bought or sold at the end of the trading day based on their net asset value, NAV. Flexibility. This trading flexibility allows ETF investors to react quickly to market changes and utilize various trading strategies, whereas index fund transactions are executed at a fixed price once per day. Thus, the correct answer is A. ETFs trade on stock exchanges, while index funds do not. 39. Which type of fund is most suitable for an investor seeking tax benefits under Section 80C? A. Balanced fund. B. ELSS, Equity-Linked Savings Scheme. C. Money Market Fund. D. Debt Fund. Answer. The type of fund most suitable for an investor seeking tax benefits under Section 80C is B. ELSS, Equity-Linked Savings Scheme. Explanation. Tax benefits, ELSS funds are specifically designed to provide tax deductions under Section 80C of the Income Tax Act, allowing investors to claim deductions of up to 1.5 lakh rupees per year. This can lead to significant tax savings, potentially up to 46,800 rupees annually. Investment characteristics: ELSS funds are equity-oriented, meaning they invest a substantial portion of their assets in equities. They also come with a mandatory lock-in period of 3 years, which is the shortest among all tax-saving instruments under Section 80C. Comparison with other options. A. Balanced fund. While balanced funds may offer some level of tax benefits, they do not qualify specifically under Section 80C. C. Money market fund. These funds do not provide tax benefits under Section 80C. D. Debt fund. Similar to money market funds, debt funds do not offer tax deductions under Section 80C. Therefore, the correct answer is B. ELSS, Equity-Linked Savings Scheme. 40. A well-diversified equity mutual fund has lower A. Systematic risk. B. Unsystematic risk. C. Market risk. D. Liquidity risk. Answer. A well-diversified equity mutual fund has lower B. Unsystematic risk. Explanation. Unsystematic risk defined. Unsystematic risk, also known as specific or idiosyncratic risk, refers to the risk associated with individual securities or sectors. This type of risk can be mitigated through diversification, as spreading investments across various companies and sectors reduces the impact of any single investment's poor performance on the overall portfolio. Systematic risk. This is the inherent risk that affects the entire market or a large segment of the market, such as economic downturns or interest rate changes. A diversified equity mutual fund cannot significantly reduce systematic risk. Thus, a well-diversified equity mutual fund primarily lowers unsystematic risk, making B. Unsystematic risk the correct answer.